There is so much freaking out going on that Vanguard literally just sent this email. You can't make this up. Look at this. Stay the course. We'll be right there with you. With the White House announcing new tariffs, markets have become volatile, testing the resolve of even the most disciplined investors. During uncertain times, resist the urge to deviate from your financial plan. The best and worst performing days of the stock market often occur in close succession. Blah, 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 blah. In other words, asset managers are freaking out across the world so badly at the idea that they could lose assets under management to gain fees from and hurt their revenues. Or worse, get margin called. Yikes. Hey, so there's a lot of drama about why Donald Trump hasn't made an announcement yet on tariffs, that it's been 36 hours over the weekend, Donald Trump's been golfing, and why the hell hasn't there been some form of tariff deal yet? Oh my gosh, what's happening? Well, this panic might potentially be driven by the fact that margin calls were hitting some of the largest hedge funds in a wave that we haven't seen since early 2020, which is at this point 5 years ago. Crazy to think it's already been 5 years. But there's potentially this idea that hedge funds are getting destroyed, and so they're vocalizing their opposition to tariffs more loudly than usual, leading some to wonder, wait a minute, what are Donald Trump's actual plans here, and what does this mean for us? Well, that's what we're going to talk about in this video. Not only am I going to give you some updates in terms of who's being oddly silent and who's being oddly vocal right now, but what we're going to do is we're going to try to understand the flip side to tariffs, outside of just the bad of tariffs. Let's try to see maybe what Donald Trump is seeing in these tariffs, and maybe that could give us a bit of a roadmap for where the stock market might go in the future. And has the downside already been priced in? Regardless of what happens over the next few days, what we really have to evaluate is what is the market going to do over the next 6 to 12 months, or dare I say 6 to 36 months, as frankly, we have seen 3-year recessions take hold in America. Now, first, I'd like to mention who's being vocal right now. And that's Bill Ackman. Now, Bill Ackman, he runs a hedge fund, and he's sort of famous for, in the middle of COVID, going on CNBC, complaining about how we need to shut down the entire economy for 30 days to stop the spread of COVID. And little did we know, but we later found out he had a bunch of very short-term put options that turned millions of dollars into many billions of dollars for his fund as he spread emotion on mainstream news media and led markets to collapse further. He did something similar with the bond market, where he was all of a sudden shorting the bond market, suggesting that treasury yields would skyrocket well over 5% on the 10-year. And then as soon as treasury yields got to about 4.99%, he flipped strategies, covered his shorts, and ended up buying treasuries that he said were untouchable because they were going to skyrocket past 5%, and ended up going long on them right at 4.99%. So when this person speaks, I think you have to just consider that he likely has ulterior motives. He has trades going on in the background more often than we can even possibly imagine. And so I think it's very fascinating, and people are justified in questioning Bill Ackman's posts here because he's just been exposed as somebody who's more self-interested than he is globally interested. But Bill Ackman here writes, we need more time to negotiate tariffs. Trump's phone's going to be ringing off the hook here, and I would therefore not be surprised to wake up on Monday with an announcement from the president that he's postponing the implementation of tariffs. The problem is, you can't resolve tariffs in a matter of days. We need time to be able to negotiate these tariffs. A lot of people are suggesting that Bill Ackman might actually be so leveraged that he's absolutely getting destroyed by this market crash that came so rapidly after the tariff announcement. Mind you, nobody expected that cardboard to be put up. In fact, markets were rallying when Liberation Day started. When Donald Trump came out, started talking about 25% levies on Mexico, which we were already familiar with, markets were actually up 1 to 1.5% because people were like, we're going nowhere here. This is great news. When the board came up, markets straight up tanked. And so it's likely that institutions thought most of the bad news was priced in, and then they went leveraged long, and then all of a sudden when we saw what the reality was, the institutions got absolutely hosed and margin called Thursday and Friday. Bill Ackman could be part of that group. It's entirely possible that Bill Ackman is facing some of the largest losses ever, and he's panicking, begging for a delay. Now, that's just speculation, so we don't know. All we could do is align what we know about Bill Ackman's past with what he's tweeting now. But what's also interesting is it's not just Bill Ackman who are doing odd things on social media. But people like David Sachs, who rarely goes, even a few hours without posting on X, hasn't posted on X for 4 days. He's the White House crypto czar. Is this a sign that he's super anti-tariffs? Elon Musk has also been very quiet on tariffs, except for tweeting over at Doge that if tariffs don't work, why do 170 other countries use them? Which is basically what every single right-wing proponent has been spreading on X without actually going into the details of the mechanics of this. Now, we've already discussed those, so this isn't really the video or place to start breaking down why this allegation doesn't hold a candle. But what we'll do instead is we'll just talk about what Donald Trump's actual plans here might be. Keep in mind, Uber bulls who are bullish every day, promising you face-ripping rallies and a big V-shaped recovery like Tom Lee, haven't posted on X in 3 days. Also very rare. Dan Ives, Uber Tesla bull, just cut his Tesla price target 43%. So you do have some interesting dynamics happening on social, but Academy Securities puts this together very nicely. They suggest you have to remember that Donald Trump doesn't necessarily want deals. In order to understand Trump, you have to understand the potential upside to tariffs. I know, I can't believe I'm actually saying the words upside to tariffs because personally I'm opposed to very large tariffs. I'm opposed to most tariffs, even those that other countries impose on us, even though the average trade-weighted tariffs against us are really between 1 to maybe 6% on some of the high levels. Some of the tariffs we're imposing now are pretty dang severe. But let's focus for a moment on the potential upsides. Academy Securities suggests that Donald Trump doesn't care about the stock market right now because he parrots what people like Chamath say, who's also close to the administration, that the top 10% of households own 88% of equities. Therefore, it doesn't matter that the stock market falls. Forget about your 401k, forget about your grandparents' wealth, forget about your wealth or your savings or your buy the dipping. It's all going down because the means are worth the end. And the Academy Securities suggests that the end is that you use tariffs to buy and spend on U.S. manufacturing, U.S. jobs, and building infrastructure. See, in their ideal case, companies end up taking in the margin the price of tariffs. Whether it's the exporter or the importer, they end up taking in the margin the cost of tariffs. Another reason the stock market would go down. This, however, would leave the buyer's price, your price for, say, an iPhone or whatever, the same or close to the same. Certainly not up 40% like some of the tariff levels that we've seen. Otherwise, people just wouldn't buy the devices anymore. But anyway, the idea would be that the price for consumers would remain the same, and the price that is basically earned by companies goes down, and the difference in the middle here is money that the United States can raise in the form of tax revenue to then fiscally spend on things like manufacturers, jobs, incentives for manufacturing in America, tax credits, tax cuts, whatever. That's the goal or sort of the vision. Now, the reality of that happening, if we actually create a terrible 10-year recession, maybe not that long, but 3 to 10-year recession, is obviously to be determined. But Academy Securities makes it very clear here that Donald Trump is doing a, quote, phenomenal job of pushing the world away from us. Now, that's somewhat dangerous. See, the Wall Street Journal suggests that this has been happening longer than we've even been paying attention to it. At the beginning of this Trump administration in January, China tried to pre-negotiate tariff resolutions with the United States before we got to an all-on trade war. But according to the Wall Street Journal, China, quote, found only closed doors. There's a suggestion that China had previously worked with Jared Kushner through channels to connect to Donald Trump to work out deals in private, essentially, before publicly engaging in trade wars. This time they've tried to do it through Elon Musk because of its exposure to Giga Shanghai, but so far nothing has worked to get Beijing a channel to negotiate with China. This suggests that the door is pretty damn well closed. Now, why would that be? If it truly is that Donald Trump wants to negotiate with these other countries, why is the door to negotiate closed? Is this just part of chaos theory? Or is it because if Donald Trump actually negotiates free trade deals, we won't end up getting the jobs or the manufacturing in America that Donald Trump is hoping for? Now, Steve Bessent suggests that, don't worry, we're not going to go into recession, but then there are also rumors now circulating on Capitol Hill that Steve Bessent might actually step down as Treasury Secretary because he doesn't believe in the tariffs that we're seeing now, as much as the Trump administration does, or people like Howard Lutnick do. Howard Lutnick just this morning suggested that we're not pulling back tariffs. We're sticking it out with tariffs, and we're not making any adjustments or delays. Now, we've seen discoordinated commentary from people like Lutnick and Trump before, but what we should really evaluate here is if tariffs are here to stay, then there's probably quite a bit of room for valuations to get even cheaper. In fact, those aren't my words. Those are the words of T.S. Lombard, who has actually been quite bullish in this market, as well as the words of Morgan Stanley. See, Morgan Stanley suggests we would argue that at current levels, credit markets are pricing in just a 15 to 25% chance of recession, lower than where our economists would estimate the real-world probabilities to be. In other words, we think there's ample room for valuations to get even cheaper with the big moves we've had in the last trading sessions. Risk outflows and weaker liquidity mean that the next leg of repricing can happen fairly quickly. T.S. Lombard suggests that these right now are market pricings of recession over here on the right, or future growth, this 2.2 level. Whereas usually when we have a recession, this bright green level goes all the way down to about 0.4 or certainly under 1 in terms of where markets are either during or immediately post a recession. We're well above that in terms of growth expectations. On top of that, the credit conditions index signaled a decline last month due to a decline in risk appetite, but in April, all categories have been plummeting. And if you look closely here, I know this looks like a big Etch-a-Sketch and it looks really stupid, but it basically just plots variables on a chart and then takes time and puts a line together. That way you can kind of see where you are right now and then see where the line goes. And you can see right now it's in the downturn quadrant, pretty solidly in the downturn quadrant. In fact, it came from the downturn quadrant, it came from the downturn quadrant, which came from the downturn quadrant, which came from expansion. That's why they put these little crazy lines that look like some child drew them. But anyway, this suggestion over here that current indicators, leading indicators, are suggesting that we are facing not a slowdown, not a recovery, not expansion, but rather a downturn, or something that markets have to price in. And this is why people are likely flocking to cash and bonds. And at least what we're seeing over at HouseHack is that people are diversifying to real estate exposure as well. Now, personally, we're not going to buy the dip in real estate at HouseHack until the third and fourth quarter, because then we'll know, are these tariffs just negotiating? Are these temporary issues? Are these longer term issues? But we think this winter, when nobody likes buying real estate, there could be some really incredible opportunities to buy real estate and buy the dip in markets, whether it's Texas or Arizona or Florida, where markets have been under a lot more pressure than underbuilt markets. Anyway, if you want exposure to HouseHack, go to househack.com. Open to non-accredited investors. We're offering a 5% yield, all of the upside in the stock and downside protection. Now read the paperwork on this, but it's pretty amazing because if our stock valuation goes up, you get all of it. And you get paid 5% on a monthly basis. So every month you get a check and you get all of the upside that we can generate over at HouseHack. So it's pretty incredible, and it's a nice way to diversify. I think it's one of the reasons we've raised over $3 million already, and we've only kind of quietly been fundraising for about a week and a half now, which is remarkable, and it's growing. It's adding to the cash pile that we have, now over $10 million, and it's adding to the cash pile that we have to deploy into real estate. But anyway, something else to keep in mind right now is there's a chart showing investment grade spreads versus, basically history when there is a recession. And this is a quite interesting chart because if you look closely at this, you could see that valuations are, quote, nowhere close to prior recessionary peaks. This would be your investment grade spread here. The higher the number goes, the more risk is priced into the market. And the same is true for your lower credit quality, your high yield spreads over here, like your triple Bs. Ignore those titles, they're a little confusing. But what you should look at is right here, April 2025, investment grade yields are at 102. Well, in 2016, we were twice that. In 2008, we were 6 times that. In the dot-com bubble, we were twice that. You get the idea. And in high yield credits, we were twice that in 2016. We were 7-ish times that in 2008. We were also about 2 times that in 2001. So you can see where really valuations are, quote, nowhere close to prior recessionary peaks. Now, in fairness, corporate balance sheets remain very, stable, very strong, which is good because it actually suggests that companies maybe do have the ability to take it in the margin, so to speak, in terms of some of these new tariffs. However, just keep in mind, once the S&P 500 goes into a bear market, it's relatively rare for you not to have a recession. It has happened in the past. It happened with a Black Monday in 1987. It happened in 22. It happened in 66. But it usually doesn't. When the stock markets go into bear market, like in 29, 37, 46, 57, 61, 73, 80, 2000, 2007, and 2020, you usually end up into a recession. A non-recessionary bear market could be an S&P 500 drop of 22 to 34%. A recessionary bear market could be declines of 40 to 50%, which means the declines we've seen so far could just be the beginning of the declines. Now, who knows? I mean, again, it doesn't matter really what happens over the next few days. What matters is what is the direction of where we go over the next months. And so far, it seems like Donald Trump is purposefully at a golf tournament this weekend to signal that he's not really interested in negotiating. He's actually interested in truly rebuilding America's manufacturing via tariffs. Now, we have had some enthusiasm building updates, such as that from Vietnam, but they make up a fraction of our trade, less than 1%. And Taiwan, which also makes up a small portion of our trade, but a little bit more so. We import about $116.3 billion from them. They only import about $42.3 billion from us. In terms of, an import basis of what we import, that represents 116 divided by about $4.3 trillion of imports, represents about 2.7%. So still a fraction of the trade. A big portion of trade we've got to talk about would be China. But these countries have had suggestions that they're open to no tariffs and a sort of free trade negotiation. But we haven't heard of any deals announced with them, probably because Donald Trump doesn't actually want free trade with these countries, and they're not really giving up that much. They don't import that much of our product to where the tariffs make sense for them. They have a lot more to lose against our big tariffs compared to just giving us free trade. That's not a big deal. Taiwan, in fairness, has had tariffs of about 4.13% on our industrial goods and 15% on our agricultural goods. So they haven't had free trade with us. Now, if you weight that out, it works out to 6%, which is obviously a far cry from the 30, 40, 50% we're imposing on Asian countries now. But it shows you there are tariffs. It's nowhere near the magnitude of what we're imposing. This idea that we're doing reciprocal tariffs, we already know it's really just a marketing gimmick at this point because they're not reciprocal. They are reciprocal in that they have tariffs and now we have big tariffs. But that's about where that reciprocity stops. Now, Morgan Stanley also suggests that a U.S. recession is not their base case, but it is definitely a real possibility. Consider this comment right here. Our economists highlight that if announced tariffs remain in place for a non-trivial period, more than obviously a few weeks, like if they last for many months, the risks to growth skew meaningfully to the downside and risks to inflation to the upside. In other words, don't expect Jerome Powell to bail you out. There's still talk almost every single day about, this would be a great time for Jerome Powell to bail out markets. This is not like other crashes where in 2008, the Federal Reserve was able to support bailing us out. Or in 2020, they were able to bail us out because we were facing low inflation in 2020. Or in 1987, when the Fed put became a standard, the idea that the Fed will always come bail you out. These cases were situations where the Fed was able to do so. But what we're facing right now is stagflation, which puts the Federal Reserve into the worst case scenario. And they really can't act until unemployment falters, which this last unemployment report we got makes it even less likely the Fed's going to cut at all, despite the fact that markets are pricing in 4 rate cuts this year. That's probably because markets think we're going to get a dirty recession between now and the end of the year. Should be unfortunate. You'll also likely see that with oil, mind you. A lot of folks are looking at oil, suggesting that oil demand usually falls to zero in a recession, at least oil demand growth. And frankly, the longer these tariffs stay, the more oil demand problems we end up facing. This could be why oil is selling off. Some people also suggest that gold is a safe haven asset, but when you go into a recession, gold does usually fall, and that may be because valuations fall so much in other assets that people use gold to sort of cover. But take a look at this. I find this interesting too. This just shows you a chart in blue of the reciprocal tariffs that we have imposed relative to some of the other tariffs that we've imposed in the past. And you can just see how much larger they are compared to previous tariff announcements, like the 2018 trade war with China over here in pink. Nothing compared to what we've seen since. So anyway, this gives you a little bit of a catch up on what's going on. It gives you an update on, Besant suggesting, hey, we're not going to see a recession, and Lutnick suggesting, hey, everything's fine, we're not going to negotiate. But it also shows you that some people who are usually uber bulls are going oddly quiet. Some people who are usually uber Trump supporters are oddly quiet. And some people like hedge fund managers seem to be freaking out. But then again, if Donald Trump's goal is to bring jobs to America, negotiating isn't in his best interest. And unfortunately, that means there's a greater chance of more downturn going forward. And this is something really important to pay attention to. Anyway, if you found this video helpful, please consider subscribing to the channel. Check out househack.com if you want to diversify away from the craziness in these markets. You can go to our website, you can see our financials, you can see the properties that we hold, you can see everything that we're doing, and I promise to always provide you updates. Any questions you have, email us at ir@househack.com. And you're also welcome to join us in the live streams that I do every single day with course members, and ask questions directly to me. So if you're not a course member and you have questions about investor relations questions or whatever you want to ask them of me for HouseHack, just email us at ir@househack.com. We'll get you a one-time invite over into the course live stream so you can ask your question. Thanks so much for watching. We'll see you in the next one. Goodbye and good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.